So continuing the tradition of acknowledging some of the Clean Tech Investor Summit speaker alums, I also want to give a quick shout out. I saw Rayad Fazani here, former CEO of BP Solar. I saw Warner Phillips from Lemnis Lighting. Thank you guys for continuing to be part of this community. While you guys get mic'd, one of the clean tech and VC communities' key issues and challenges is figuring out our capital markets and figuring out how to bridge this gap from private to public companies. And understanding the state of the capital markets is critical to understanding how we finance our private companies. This panel has always been one of the highlights of the Clean Tech Investor Summit. This year we have some of the best, most insightful, most experienced folks in the clean tech industry share their thoughts on the state of clean tech exits. As I was thinking about who would be the right person to moderate this panel, I couldn't think of anyone better than my friend, my co-investor, Nancy Pfund. Nancy is founder, managing partner of DBL Investors, previously an MD at JP Morgan, joining in 1984 as a securities analyst, and later helping lead its VC group. 1988, Bush 1 appointed Nancy as a member of the National Advisory Council for Environmental Policy and Technology. In 99, another appointment to a commission by Clinton. She sits on the board of the California Clean Energy Fund. She's one of the pioneers, granddaddies, matriarchs of the clean tech industry. I come from a family of 3 boys, and as she knows I feel this way about her. She's like that sister I never had. Please join me in welcoming Nancy Pfund and some of the top clean tech groups on Wall Street.
Thank you so much, Ira, and thanks for just a terrific conference. I think we're all just ready to go out there and change the world after being here for a couple of days. So thank you, Ira, and thanks to my panelists. We have a terrific group here to talk about exits, which is on everyone's mind always. I think I took a look at some of the stocks this morning, and my conclusion is that we should have these exit panels more often, because last time I looked, First Solar, SunPower, Tesla, Amyris, Gevo, Cure, Solazyme, we're all up today, and the markets are, the indices are flat, so I think we're off to a good start here.
Every day?
Yeah, okay. So what I'd like to do is we're going to have a dialogue here. There's lots to talk about. We don't have a lot of time, but we're going to get into it. But I thought I'd let my panelists introduce themselves and just give us a little bit of just a preview of how you're feeling about 2012 and exits. But let's keep it short, and we'll get into a dialogue. Michael?
Well, thank you for having me. I'm Michael Horwitz. I've been a senior research analyst in the clean tech sector since 2005 with Robert Baird. Just recently, in the last week, I've moved over to the other side, and I'm now heading up our clean technology banking effort. 2011 was fairly interesting because the first half was quite good, a lot of activity, and then as Jonathan mentioned, the world came to an end perhaps in August and throughout the fall. I feel for 2012, people just want to differentiate what companies they're looking at. We need to educate them continually. We can't lose the momentum or lose sight of what the bigger prize is. And I think later in the back half of 11, we got a little bit short-sighted.
Radford Small, Goldman Sachs. I spent about 90% of my time in the clean technology space across a wide variety of verticals. I would summarize by saying I'm very optimistic about 2012 and beyond. I think we're moving towards a world where there will be more economic stability going forward. It won't be linear, but I think we will continue to improve. And against that backdrop, I think that's very favorable for renewables. And in terms of exits specifically, and I think we can get into some of this later on, I think you'll continue to see 2 trends in particular. One is on the project side with the upstream panel providers in solar selling projects downstream to those entities who are best equipped to own them, so Mid-American IPPs. That's one trend. I think another trend we'll continue to see are large corporates, whether it's industrials, major oil companies, others, who will continue to focus on the space and try and find ways to enhance their business lines or their product suites or get into new businesses. And so I think those are 2 trends we'll continue to see moving forward.
My name is Kevin Genieser. I'm a managing director of Morgan Stanley. I head up our clean tech group. I've been at the firm for about 15 years. the last 6 years, I've focused exclusively on clean tech. And, you know, Nancy said, you got to be positive, so just make sure you find all the silver linings out there. So I'm going to try to follow that directive. Look, 2011, it's hard to say it was a good year. But if you look for the silver linings out there, we saw much more M&A activity with $36 billion of activity coming into the space. That was up 55% from the prior year. We saw a lot of interest from large industrials, large acquirers coming in. Valuations may not have kept pace with where some people thought they should have sold, but I think it did signal that people thought there was real value in the space, there was real long-term growth potential. And if you looked at the number of IPOs on file, I think we've now got about 14 on file, almost $2 billion overall value. There's a lot of potential capital markets transactions coming just around the corner here. So I think I agree with Rad that I'm hoping that this is going to be a very strong year going forward. We're starting to see some of the markets recover with the VIX and some of the other things coming down. I'm not sure clean tech is going to be the front of that line, but that's maybe something we can get into a little more dialogue as we talk about the exits.
And I'm Russ Landon. I head the clean technology practice at KeyBanc Capital Markets. So to follow along the line here, a lot has been said, and I would, and to follow Nancy's guidance to be bullish, I do think that 2012 has a lot of opportunity on the heels of 2011, which was very disappointing in a lot of ways. I would agree with Kevin that the M&A activity seems to be heating up a fair amount, and I would argue that we might see a lot more of that. I think we'll have a positive IPO market. The fact of the matter is there's a lot of technology deals and others that may well come before clean tech, so I wouldn't get too excited about a huge run there until we see the technology clean itself out. The other comment I'd make is that, yes, I'm long-term positive, but I'm short-term leery largely because of the public opinion and political issues floating around, and it makes this sector incredibly volatile, and volatility generally means downside, not upside. And so, Wednesday after the election in November, I'll breathe a little bit of a sigh of relief, but between now and then, we're going to have a lot of crosswinds, and I think there's a lot of things that spell out to look good in 2012, but I think we have to be realistic about some of these crosswinds that are going to happen during the year.
Okay, well, let's start then picking up on that theme about public sentiment, Russ. If you look at the surveys, the Pew Charitable Trust, there are lots of opinion polls that actually say that support for renewables, support for clean tech enjoys very strong bipartisan support. I think it's 80% of Republicans, 84% of independents, and 90% of Dems are supportive of this energy transition. You have George Shultz, who's pretty up there in terms of Republican ranks, calling for an end to oil subsidies and a carbon tax, and very supportive of renewables and clean tech in general. So is there a disconnect with and getting to Charlie's question, I mean, there's widespread support, the studies, the surveys show that, and yet there seems to be a short-term malaise on the part of some of the buyers of these stocks. So how do you gentlemen feel this is going to play out in 2012? Of course, we have an election year that distorts everything, but those numbers have been pretty steady over the past few years.
One of the things that's unfortunately happened because of 2011, and as Jonathan was saying, the pool's a lot more shallow in terms of who those buyers are, and there has been some moving around of portfolio managers throughout firms, and some of those people that we were talking to 6 or 9 months ago haven't allocated the bandwidth, at least right now, to clean technology. So it's up to us to reinvigorate, to educate, to differentiate the various companies that are in the pipeline. I think too many of these get caught up, XYZ company is just like ABC, and that's not the case. So we got to push through that, but this is a new education that needs to happen, and there are frankly fewer people willing to pick up the phone.
And Nancy, I would say that, to your point, there is a disconnect, and if you dig in, you understand, I think there is support within a lot of areas, in DC, et cetera, to make this happen ultimately. The problem is, again, you're at election year and you've got these cross currents that are about winning votes, and it's like, well, comments like, that, carbon was is a stupid idea and this sort of thing. I mean, it's just, so you're going to have to deal with these cross currents, and the challenge is when you're talking about public investors, that when you sort of take a body blow like comments like that, it makes everybody sit back on the heels a little bit. Michael, you mentioned last night something interesting too. There's been a lot of turnover in portfolio managers. So if you've got people that are newer to the space, they're going to be more subject to and willing to react to these kind of to these comments that come sometimes out of left field. But the fact is, they're there.
Yeah, I may just add that, I'm as bearish, I think, as everybody else is up here with regards to government regulation and getting anything done here in 2012. The one thing, though, is I think that many of the companies that we talk to have adjusted to the new reality. I mean, of course, people would like handouts, they'd like some sort of credit or some sort of support out there. But what we've seen is there's a number of business plans that have come forward that are really adjusting to the new reality. The new reality being not the same level of support, low gas prices. How do you take advantage of that? What does energy efficiency mean? What does the near-term return look like for some of these technologies? So I think clean tech is going to morph. Maybe it's going to expand. Maybe there's a broader concept of sustainability. I think you'll see new ideas that will be coming forth over the next year that have already adjusted to the new reality that we're working in.
Well,
one thing to add on that, I think the biggest negative impact from all the rhetoric is that it causes people to question whether subsidies will be there. Not new subsidies, but just the ones in place today. And the most critical one that we see this year is extension of the production tax credit. But I think against a backdrop of uncertain regulation, investors are less willing to invest capital. If you provided certainty around the subsidy regime, whatever it was, and people knew it would be that way for a period of 5 years, 7 years, 3 years, whatever it is, I think that would alleviate some concerns on the parts of investors.
Well, and certainly we heard in the State of the Union address last week a recognition of the role that subsidies have played in traditional fossil fuels. And it seems to me that there is a whole body of opinion that says that now that it's more widely known that fossil fuels have been subsidized for, in some cases, a century, that the prospect of a PTC being extended has actually gone up. And so that's kind of a newer idea that could help us in 2012. Get some of that visibility you're talking about, which is critical. In terms of the role of our public markets, the capital markets, I mean, we're all focused on natural resources here. They are a tremendous financial resource of our country, and they have really been the backdrop against which we've seen incumbents displaced by innovative new technologies and companies. It's often messy. I mean, these buy-side analysts that you're talking to, any transition is messy. There are companies that don't make it, and you don't know who they are in advance. But I mean, is this really any different than what we saw in the early days of biotech and the transition from mini computers to personal computers? I mean, we could just go through the decades and see that it takes a while for all of this to settle. So why this extra pessimism in terms of what's happening here? It doesn't seem that different.
Look, I think a lot of the pessimism deals with, unfortunately, a lot of the companies we talk to still have negative EBITDA, negative margins for a period of time. And so, I think it's a broader statement about the market. If you ask, there have been IPOs done, some IPOs done very successfully, 99% outside of the clean tech space. But what they brought is they brought new business models, they brought cash flow, they brought a number of things that investors get comfortable with. Unfortunately, the profile of many of the clean tech companies that we deal with that are ready to go public don't quite have that same sort of either growth profile or clear understanding of where the dollars are going to come from in the next few years. Growth is their long term. I don't disagree. I don't doubt that. The real problem is that many investors are short term looking right now with the risk off nature of the markets. Now we've seen it improve. I think 12 is off to a much better start. I'm optimistic about where we may get to in 12, but it's relatively, it still remains a challenging market.
I mean, it is pretty amazing that it was the beginning of 2011 and investors were willing to look at 5-year discounted cash flow analysis to get Solazyme public and Kior and some others. And here we are 7 or 8 months later and 2-year DCF and we can't even think about that 5-year situation. And those stocks are down 40% because people pulled in that horizon. But we are marking time. And with that marking of time, the pipeline that Kevin mentioned, some of those companies have marked enough time and have some great milestones they're hitting as we speak. And I think there's a good handful there that can get public, even in the face of some of those headwinds.
One other challenge I just add is this, the other problem we have is that a lot of these are great houses in a really bad neighborhood. If you look around, the comp sets have been beat up so badly. The most indices are down 40 to 50%. Some subsectors are down 60, 70, 80, 90%. So the challenge we've got is I'm looking for the new champions, people to compare some of these companies back to. We may have to look outside the clean tech space as we talk to some of the smart grid companies and some of the others out there, somebody to say, hey, these are great business models, great ideas. Let's look for those as being a way to think about valuation as opposed to looking just within the clean tech space.
And Nancy, I'd harken back to what you said when you introduced the question. That was, gee, haven't we seen this before in other sectors, in technology and biotech? The answer is yes. It does feel like a lifetime, believe me, since we've been going through this. But in this sector, one thing, particularly compared to technology, just remember two fundamental differences. One, the capital intensity of the business, and two, the aspect of subsidies or whatever the requirements are outside to make it profitable that it might not otherwise be. So I think that this industry, again, has all the great success we're talking about as an opportunity, but it's got two big hurdles that it's got to deal with that some of the other spaces don't have to. And it comes, it makes it difficult at times, particularly when you've got a trade-off in the markets.
Well, I agree with the point Kevin made, and I think it's important to realize it's just human nature. When analysts and investors look at a new business model or a new technology, they automatically try and put that into their own frame of reference in something that they can compare it to. And if you look at what they're comparing it to, it's the solar market that had severe downdraft last year. It's a market where 9 out of 10 IPOs are still below their IPO price. So this is where I think we in the financial community can be helpful, which is educating analysts, educating investors to realize that notwithstanding that, some of these stories, like Kevin said, are really great houses in a bad neighborhood, and you really should spend the time and the effort to learn about the business model and learn about that space.
Well, how important is it that First Solar is up, 35% from January 1st? Isn't that a...
Doesn't hurt. and the new energy finance index is up about 13% on the year. So
the indices are up at least
That's
10%.
nice, but after being down 70 or 80%, people are still suspicious.
Well, but we always hear about having to clean out your portfolio year end and not wanting to and starting afresh after the holidays. I mean, sooner or later, these trends have to be working for us. Coupled with, we all saw on the downstream side, Q3 was a record number of solar installations, almost 450 megawatts, which was more than happened in the entire year of 2009. And what I'm hearing is that Q4 is looking even better, which is usually not the greatest quarter. And then you're also seeing, even in the CPV market, you're seeing some of the companies, they're able to sell out their 2012 supply, or a big chunk of it, and we're only in February. So these are the kinds of positive dynamics that usually wake people up, combined with some of the big names like a First Solar coming back to life.
Well, I think the biggest challenge is you take a very broad brush when you talk about clean tech, and there's a lot of very strong sub-silos that are within that broader umbrella of clean tech. And so you've got to look down to say, well, where are the areas of growth? Who's getting the benefit of having falling panel prices? Who's benefiting from low gas prices? There are parts of the clean tech space that will do extremely well in the market that we see that's coming here. The challenge we've got is most of the names have gone public have been the areas that have been hardest hit. The module manufacturers, the wind turbine guys. I mean, all those folks are the ones that have been most troubled in this very challenging market.
The other thing that occurs on the buy side is we're talking about this very limited number of clean tech portfolio managers. In reality, all of us are looking at the big mutual funds and talking to their chemicals guys or utility portfolio manager. There's a broad base that clean tech can touch, and it's up to us to educate other parts of those organizations and not put ourselves in this box. And the thing in particular with solar is solar became covered by semiconductor analysts for the most part. And when this all just happened in the last 18 months, they have a lot of other things that they can go concentrate on. But as it relates to biofuels and biochemicals, not only can we talk to clean tech people, we can talk to the chemicals folks and the fuels folks at the big mutual funds, and we're going to continue to do that. That's a process.
It's a really important point you made. We see it in our own shop, too. One of the big challenges in clean tech is it's such a broad space, definitionally, and it hasn't got enough, history and depth yet to have, with some cases, you've got, clean tech analysts on the buy side, but a lot of cases, to your point, you're talking to chemical analysts, you're talking to industrial analysts, and so if you don't have enough cohesiveness to sort of get the whole sector sometimes, it makes it, and that's, we've got to work through that. Again, I think you look forward, next year and the year after, you're going to have more and more analysts and PMs that are focused just on this one set and defined uniformly as clean tech.
So let's talk about the interaction between the IPO market and the M&A market. We heard the Total SunPower story earlier this morning, which so far the early returns are looking good on that, and SunPower, as I mentioned, this got a little uptick going. The trends are related. I mean, and certainly from our perspective, when we participated in, we were investors in Powerlight, which was then acquired by SunPower. So we kind of went through this story a few years ago. I can't picture Dan Sugar getting coffee for Tom Werner, though. I just don't think that ever happened. But what people may not remember is that Powerlight had actually started the process to go public, and that was we were quite moving along that path, and then SunPower came in, and the rest is history. But certainly, that's an example of where we feel that the fact that we had started that process helped get us a better price, and so it's important to have both sides of the market in terms of what our goals are, maximizing the return for our investors. So how do you see that playing out? You've seen, you mentioned the rise of M&A, and we've seen some great examples, but do you think there's going to get to be some scarcity value, and that some of these companies will actually command the kind of premium that we'd all like to see?
Well, I can start on that. I think we still see this disconnect between value expectations on the sell side and on the buy side. So I think that's one disconnect. Another disconnect is many of the best placed buyers, so the large industrials and large corporates, tend to prefer companies that have more financial history, positive cash flow. So it's more difficult for them to invest and acquire technology-based companies that come along with technology-based valuations. I think that gap is compressing, and I think we'll continue to see more of that, but I think that's one thing that has prevented more M&A in the past, and I see that trend continuing to get better. And I see the IPO market, I think, will continue to strengthen. Hopefully we'll have some good data points here in the next couple of months with companies that are on file. And that the more that becomes a viable alternative for these private companies, the more that will support M&A valuations, because it's just another option that the companies have in order to exit.
So what about the role of China? I mean, we've witnessed its impact on the PV industry. A lot of companies now are taking the approach of partnering. There are all kinds of joint ventures. There are manufacturing plants being built in China by U.S. companies with combined financing from both sides of the Pacific. So how will investors react to that? Is this a net positive? Is it sort of the you can't beat them, join them type of thing? Or is this going to confuse people even further?
I think it's an acknowledged it's going to happen, and I wouldn't say there's surprise one way or the other. It's just I think investors are pretty cognizant of how much it's not just manufacturing, it's where markets are over there as well. And so if you're in a business where China or other Asian countries are an important part of your business, I think it's anticipated and expected and no surprise when you've got those kind of arrangements, and I think you see more of it.
I mean, I think it's a foregone conclusion. I mean, look at China just demographically. Electricity consumption is going up double digits per year. So whether you're talking about meters, smart grid, software, generation technologies, I mean, they're the largest market for those types of technologies. So I think if you don't have a China strategy, or at least have analyzed China and how you will interact with that market, I think you may be missing something.
I think it's also giving a second life to a number of technologies that just haven't gotten adopted here in the U.S. So folks that are looking at things like coal gasification or new ideas on how to do things with some other forms of fossil fuels, Hard to get done here because we're not building new coal plants here, right? They're building a heck of a lot of them over there, and they say, hey, let's not focus on one plant, let's focus on 10. I mean, the opportunity set for a number of these companies is absolutely tremendous. So I think we'll see more of those types of companies that go over there to find greater opportunity.
Okay, so in terms, so you're saying that the China relationship is sort of built into the expectations of these buyers and that companies need for business
But
reasons.
it's very sector specific, though. I agree with Kevin. Some of those coal gasification companies that we were excited about in 06, 07 have had to completely re-strategize and go over there. But within the smart grid space, there is so much to do within Europe, the US, and Brazil. You know, China and Asia is probably number 4 on their list. They're not ignoring it, but there's a lot to do.
Kevin, you mentioned in your opening remarks that you weren't sure where clean tech stood in terms of the queue and what the IPO lineup. And certainly we've heard of some big digital media filings or imminent filings. How does clean tech compete with the Facebooks of the world?
Well, look, I think that's one of the challenges where you see companies that are coming public now that have very strong margins and very strong cash flow. I think what needs to happen is comfort with regards to growth and long-term potential. And as I said, I think there's some subsectors that can evidence that talk about new trends, new ways to work with natural gas, new ways to work with you know, social media in their own way. I mean, we talk a lot more about names that focus on consumer empowerment. You know, how do you get to the residential customer? A lot of these dialogues that I think had gone dormant for a period of time, people are saying in the new world we're living in, let's take some of the learnings from the social media side of things and take them back to the clean tech space and incorporate and empower the end consumers. And I think that's an interesting trend that we're seeing being carried back over into the clean tech space.
You know, I think an interesting dynamic to that too, Nancy, is if you talk about looking at it from the perspective of deals in the market, and the question is, do the Facebooks and others crowd out clean tech, or do they create, hopefully, a robust IPO environment where a lot more people can jump on the bandwagon? I think it's a big question this year. I mean, and you know, we all think about, you know, as bankers, you think about, well, you want to be in a market where you're not trying to compete with everybody, but the realities of the world are the best deals happen when the market is hot, when everybody's going out at the same time. So if Facebook and others are very, very successful, yeah, there's a risk that there's this crowd out that they just look more attractive. But on the other hand, it might create a market that's just good enough that it'll open up the window for others that otherwise wouldn't be there.
You agree with that? So you feel it's the rising tide lifts all boats type of situation?
I think the more market strength there is, the better it is for clean tech and all other sectors. When investors are making money, they're more likely to invest.
Yeah. There's a lot of sheep out there for lemmings.
Okay, what about getting back to the M&A dynamic? What about the role of Europe? Is Total an exception? Do you see, or do you see this as a fairly dominant trend that we'll see more of in 2012?
It's a fairly dominant trend. I mean, we've already seen the ABBs, the Schneiders. I mean, you look at most large industrial conglomerates. I mean, one of the reasons I'm pretty bullish on with regards to M&A is simply because that's the opposite side of the downturn in valuations. Valuations have come down so far that's really very much a buyer's market out there. There's lots of great companies, lots of great ways to work together. I'm getting louder here or not. But lots of ways to work together that, you know, I think a lot of these companies are really looking for opportunities. And it comes in all forms, I should say. It's not just M&A, but we've seen a huge rise in some of these large conglomerates having VC efforts. So they put a little capital to work. They give that check mark. I mean, the guy from Solazyme obviously was talking quite a bit about that as a big benefit. That's, you know, that type of good housekeeping seal of approval is invaluable for these companies as they think about going public, and there's real benefit to that.
You know, what's interesting is ABB and Schneider have been so active, but they have 4 or 5 competitors, some who reside in the US, who have watched this play out and haven't done anything yet. So there is a list of buyers that should be getting in the water because ABB and Schneider are moving so quickly.
Okay, so we'll see. Sounds like you're bullish on the role of those big conglomerates in terms of exit strategies for some of these companies.
And maybe I'd just
Some of
add also,
those-
it's not just conglomerates. I mean, it's the folks who are doing IT, it's the Intel, and I thought that panel was very interesting yesterday. It's the Googles of the world. A lot of these folks are thinking about, well, what does clean tech mean to them? Maybe it's the smart grid, maybe it's some way to sell, more servers, more product on their side. But ultimately, they're attracted to the markets. They see the long-term growth potential.
Well, I think those companies also are trying strategically to become more ingrained in the fabric of Silicon Valley in that entrepreneurial culture. And so they're spending more and more time trying to set up offices or meeting with VCs and early stage companies, I think more so than they have in the past, just so they're part of that and they see the pace of innovation and they're apprised of current market developments.
In terms, you mentioned earlier that the clean tech sector, unlike obviously digital media or even software, has this capital intensity. Certainly biotech in its early days had a huge amount of capital intensity relative to other options on the tech side back then, and people seem to get over it. How do you educate? How do you get the clean tech industry over that negative perception and perhaps show that where there are large amounts of capital being deployed, those are some of the most significant companies that are often built over the years, and we have a history of that. So it's not all a bad thing, but it sounds like it's an obstacle.
Yeah, I mean, one of the best ways to get over is to show that there is the ability to provide, financing at a project level that, can allow the equity to lever itself better. But that's been a difficult road. And I think there's been a lot of progress made, but there's an awful lot of smaller situations that are looking for project capital, and that's not there. So it's, that's working its way through. I think the capital intensity is, it just has to be, to the extent you can't outsource the debt financing off the balance sheet, then the capital intensity just has to be built into the IRR model. And you're right about biotech, that was something they got over. But don't forget one dynamic I believe about biotech that made it in some ways fundamentally different is at the end of the rainbow with biotech, maybe 7 years down the road, you've gone through all the hurdles of the FDA, spent all the money, you got essentially a guaranteed market out there with very high margins. And if you compare that to the biofuels market, you absolutely have a market. You know you can sell your product, but it's a commodity market, and those are very different dynamics.
Sobering. I want to open it up to the audience if there are questions in terms of specific trends we've been describing. Do anyone from the audience want to ask a few questions? Otherwise, I've got many more here. Sure.
So what are sectors that you think would be your top ones to be looking at, and what would be the one that you would be most careful about analyzing?
I wonder if there's consensus up here.
Let's hear everyone's take on that.
I imagine there might be. I'll throw it out there. I think smart grid and biochemicals is the most interesting, and solar is the most difficult. And that's consensus.
I would agree, except within solar, I think you have to separate the installers from the equipment suppliers. I think the installation market is I think it's a very strong market. And I think there are lots of strong fundamentals that will continue to drive that.
And do you think that buy-side analysts do they already know about the power that, say, financial instruments or approaches like leasing have transformed the adoption rate for solar? Is that widely known and appreciated, or is that yet to come?
I would say no, because for people in this room, it's relatively common knowledge how these companies work and how they finance themselves. There really is no public market company that finances itself that way. So I think it just takes an education process, but once you do that, you really can understand the power of that business model. It's capital intensive because you need to provide vendor financing in essence to your customers, but the receivable that they originate with the customer that they're financing has very high value. And so there's no reason why they can't continue to finance themselves just like a credit card company, a car leasing company. I mean, there are lots of markets today that exist in the asset-backed space to finance these types of business models, and I think that's where the rooftop business is going.
It does beg the question, does the traditional solar analyst or portfolio manager have the skill set to analyze those new business models. I mean, that's specialty finance. So just like some of these other companies cross over into chemicals or utilities or industrials, here we are going to go into specialty finance.
I'd throw another, so we got to throw a few others in the bucket here. I mean, I would suggest that once it gets over its sort of overcapacity issues, I think lighting's got a lot of opportunity. It's struggling right now, but so smart grid for that matter. And as a result, those two sectors provide a tremendous amount of value potentially, and that could turn pretty quickly to the extent the value picks up and investors get the message there.
Do you have any other picks?
No, I mean, I tend to agree with all the other comments. I mean, look, I think there's certain sectors that have a lot of overcapacity in them. So whether it's solar, whether it's wind and others, I think those remain the most challenged. And then there's some new spaces, I think most of which have been mentioned, which have that potential for growth or clear revenue streams, and I think we'll get the best reaction in the market.
Looking out, have you seen the buy side take an interest in storage? I mean, we saw some announcements of some of the larger solar installations putting storage on, more closely approaching base load. Is this, it's obviously a big focus for the venture community. Is that translating at all yet, or too early to tell?
I think a lot of the models that are focused on ancillary services and grid support of all different kinds are really the ones that are going to emerge here in 12. I think there's been some focus on it already, but because of the challenges that some of the EV names have seen with regards to the Volt fires, or you can pick your favorite challenge that they've had. I mean, it's been a pretty rough year for that space. I think a lot of these names are going to be really rediscovered based on the potential for growth within the grid, and I think that's going to be the real exciting opportunity for them. Many already have those types of relationships. I think utilities and others are seeing it as a real option with regards to expanding their overall asset base and their ability to bid into the various markets.
Yeah, I agree with Kevin. I think the market where it's ancillary services based to stabilize the grid, that's a very timely application for storage. Grid scale storage remains the holy grail, assuming it's economic, and it's a complicated equation when you're talking with utilities about what is that storage worth to you. And if you think about a world where we're probably moving in the direction of a smaller difference between peak and off-peak power prices, because you have demand response, distributed generation lowering the peak, and you'll be charging your EVs at night, so that means that peak, off-peak spread will compress. So if that's the gap or the arbitrage you're trying to capture with storage, it's a difficult long-term equation. What are the economics of that?
And do the folks out there that have, say, understood the EV story, they may have invested, bought on the Tesla IPO, or they may be driving a Leaf, do they understand the very intricate relationship between renewables and EV, and that often a EV owner is an upsale to a solar system or some other, there's more than just one dynamic pushing forward on the renewables front?
I think they do, and it's largely the customer base that's buying the beautiful car outside. It's probably also someone who can afford to be concerned about the environment, clean technology, and so I think there's an overlap between the consumer base for EVs and those who support clean technology broadly.
I would say the one thing, though, where I think Tesla did so well was it was position EVs as just a better driving experience. And so what I think is exciting is just the whole innovation that's going into the Tesla story and the Fisker story and some of the others that are out there. And so I think that ability to really change the game, to be disruptive with regards to transportation, I think that's really going to drive the market. Look, I love the environmental aspect of it, but I think it's also the fact that it's just a better driving experience to get people really excited.
No argument here on that. So I'm going to ask you all to end with your prediction for, you've all talked about the bad neighborhood that we're in and the
Good houses.
Yeah, good houses. So will we be in a good neighborhood next year?
And I would say, I'm going to make an observation on this panel to answer that question. You asked us to be positive. We're all running around with our chins hanging on the floor here. And there's an old adage, buy on the bad news. And the fact of the matter is, we may be a good indicator with all the sort of, you have to capitulate. You have to get all the negative stuff out first for markets to do well. And I'm just going to make a bet based on the panel here that I think the market may out surprise us on the upside, given getting all the bad news out here.
Okay, bullish.
Yeah, look, I mean, I think it all depends on how you define good, right? Because I think right now there's a large number of buyers, right? So, I mean, I'm not going to raise my hand and say I think valuations are good, because I don't, right? It's just in terms, it's a challenge, remains a challenging market, but it's a great opportunity for people who are going to come in and buy companies or buy opportunities or invest right now, because it is a buyer's market when it comes to various valuations for many of the sectors out there. I think it's going to open up a lot of doors for additional M&A activity, and if you've got capital to put to work, it's a good time to do it.
I didn't know you were such an existentialist.
There you go.
I'm positive, and I think it's because of all the negative sentiment over the last 12 to 18 months, it really has forced these private companies to tighten their belt, make sure their product is economic, and so I think the crop of companies that will come out this year, whether it's an IPO or M&A scenarios, I think they will be better positioned as a result of what they've gone through in the last 12 months.
I would agree with all that, and I think, Russ, that's a good observation. I would imagine we're going to get 3 or 4 of these companies in the pipeline public over the next 3 or 4 months. And so as they go, so goes the rest of the year.
Yep.
All right, well, that's music to Ira's and my ears. Onward and upward, and thank you so much, panel. And let's gather again.